Dear clients, a warm welcome from my side. My name is Stefan Meyer. I'm the CEO of Open Funds to today's webinar with Pablo Gonzalez, the Senior Portfolio Manager at Independent Capital Group. He's responsible, among other things, for the Energy Champions Fund. We at Open Funds have been working with ICG for 2 years now because ICG fits into our aim to present interesting market segments that are not broadly covered by the big fund management houses. The agenda for today is as follows. Pablo will present ICG and their Energy Champions Fund for about 30 minutes. We will then open up for questions. The webinar will also be recorded and you will receive a link to the recording and the slides after the call. I recently read a very interesting research piece authored by Pablo and want to quote a few sentences that hopefully help to set the stage for Pablo's presentation later on. He wrote, global demand for crude oil today is around 100 million barrels per day. To put that into perspective, it is equivalent to about 6,400 Olympic-sized swimming pools that every day need to be filled with oil, one every 14 seconds. People who imagine that in a few years no crude oil will be needed are being naive. The world is not just Los Angeles and London. It is above all China, India, Africa, and Latin America. Per capita energy consumption in those countries is only a fraction of what it is consumed by the wealthy West, but these people too aspire to substantially raise their living standards. Most analysts agree that oil demand will grow through 2030. Even the International Energy Agency, in its most recent World Energy Outlook, conceded that the world remains far off a net zero trajectory, and the announced pledges of world governments today do not translate to a meaningful decline in oil demand until after 2030. So based on these few quotes, it is clear to us that the end of fossil fuels is still a long way off. Therefore, oil and gas stocks will continue to be a factor and might possibly also continue their strong performance they have shown year to date. With this, I wanted to hand it over to Pablo so that he can give us a detailed view on the energy sector and also explain the investment process of ICG. Pablo, over to you.
So thank you so much, Stefan. It's a big pleasure for me being here and having the opportunity to present to you the story about the energy crisis and opportunities, as we call it. But Stefan did a really good introduction. He could go on. I mean, you said partly some of the most important things, but let's put it a bit in a more bigger picture. What's happening and where is it going? And I prepared some slides on this topic where I will show you. Let's go through it. First of all, I will speak a bit about who we are for those who don't know us, then about our Energy Champions Fund. And as we call it, I mean, the energy crisis is also an opportunity, because if you go from, as you know, the mega trend, energy transition. So what we say, we are moving into the renewables, clean power, but it's a transition, it's a process. So what we think, it's along the supply chain, along this process, there are different opportunities. Probably today, fossils are really attractive, as I will put it. And then going forward, there will be a lot of need for industrial metals. And so if you want to play the energy transition story, I think we offer good opportunities. And then some words about our process and Q&A. So first, who we are. Independent Capital Group. Our headquarters is in Zurich. We are an asset manager company, but in Zurich we have a family office arm and a real estate arm. And in Basel, where I'm sitting right now, it's the asset management part, where we are specialized in the whole commodity, natural resources, energy, transition story. And if you have some view about our team, I mean, one of the company founders, DDOs, over 20 years ago, he started with commodities because you may say, why do you do commodities out from Basel? That's not so typical in Switzerland. But he was portfolio manager at Roche in the 80s. Roche was really well known because they had a big financial power. They were really successful in investing, and at that time, he managed, or he had the opportunity to finance the management buyout of the Mark Ridge into the Glencore we know today. So at that time, he met a lot of people from this world, and he got a lot of knowledge and a lot of projects in the commodity space. And since then, he's been a big fan of commodities. And I joined like 16 years ago after my studies. I've been for 16 years now doing commodities and natural resources equities, and running different funds. The same with Cyril Joos, my colleague, also in portfolio management research work. And here, for example, one of our advisors, Manny Weiss, as you can see, I mean, we speak a lot with the commodity traders, and Manny Weiss was the head of aluminium at Mark Ridge. And I think it's always interesting to see the different points of view from a commodity world, because we are economists, you know. So for running money, investing money, it's important to have some financial background to know the numbers. But it's also important to speak with the commodity traders, but they are kind of different. They have more the trade flows, the geopolitical awareness, and then we speak with engineers, the commodity engineers, the geographical, what are the assets. So I think in this world where it's a really mix of different things, it's important to have a broad view, because commodities is not just supply and demand, it's a much more. And that's obvious right now. I mean, let's start with energy crisis. I mean, what I will try to explain to you over these 30 minutes is that we are short in all kinds of forms of energy, because we still live in a material world, and fossils, they represent 80% of our primary energy consumption. So they are really important. And the transition, it's not done from today to tomorrow. That's really important. And the thing is that the oil demand is even growing. I mean, I will show you that the most analysts expect oil demand to grow, because the infrastructure, the process, and a lot of things, it's based on this kind of setup today. And on the other side, the supply side, we have big problems, because after 10 bad years in commodities, as you probably know, nobody invested in the supply. So the supply is getting down while the demand is not really going down right now. Maybe in the future, probably in the future, most probably in the future, but not today. And therefore, we think there are a lot of interesting opportunities in this space. And the oil and gas companies, even if they are not a favorite sector for a lot of them, they offer a really big opportunity right now as an investment perspective. And I will also show you why. And I will also show you how good they are probably moving. I mean, as you probably know, the Shell, the BP, the Total, they're moving from oil companies into energy companies over the years. They are the second most patents in green energy technology have the oil majors, you know, so they're also moving. So I think the whole space offers a lot more opportunities that's generally known or understood. So natural gas markets to start are really tight. I mean, as we all know, in Europe, we have a huge energy crisis driven by the cutoff from the Russian gas supply. Meanwhile, on the left side, you see the Russian gas supply. The Nord Stream 1 is closed. So there's just about 30 MCM per day being delivered through Turkey and Ukraine. So the supply from Russia came down by 90% meanwhile. So what Europe did, it started to import LNG, gas in a liquefied natural gas form. So we had a huge imports from other sources that had higher prices. And the good thing, despite all the crisis, is that our inventories, I mean, the estimates this morning were that we are reaching 85% of capacity for our storage in Europe. And that's a good thing, because historically we would need 80 to have enough supply going through the winter. And yeah, I mean, there are a lot of unknown things. I mean, what could happen if the flow goes to zero? What happens if the winter is more cold than expected? So there are different scenarios, but from an inventory perspective, we are at least having full inventories, but at a price. I mean, and here you see on the left side the gas prices in Europe that went totally crazy, you know. And it's not just gas. I mean, you have here the Dutch TTF, but you have also the UK gas price. But if you compare to the other energy forms, crude oil or even coal, I mean, coal equivalent on the left side, you see the chart, everything on a barrel of oil equivalent basis. So the coal price 1 year ago was at $10 to $20 on a barrel of equivalent basis, meanwhile also at 90, so every kind of energy form, the prices increase because of the energy crisis situation. And what we try to say to the people, because if you look to the markets, I mean, the oil price went from 130 nearly to 85, and the people don't really see, because what they are probably missing is that if you speak to the commodity trader, or even the Saudi Arabian energy minister said, commodity physical markets and the financial markets are not showing really the same picture. Because if you speak also to Goldman Sachs, even they said, I mean, physical markets are really tight, so, and you see it also on the right side with the energy curve. I mean, the Brent oil forward curve on the front, on the back end, it's in backwardation, and the prices are still at 75.80. So even over the last 3, 5, 6 months, the long-term forward price didn't really move down. So after everything that happened, we had huge supply coming from the US strategic petroleum reserves, over 1.5 million barrels per day coming from there. The reserves in the US are as low as in the 80s. So we had China COVID zero. I mean, the supply the demand from China was so as low as long not before seen. So even considering recession fears, considering everything what happened over the last few months, the oil price didn't came down like, I don't know, 50 or 30 or 60. No, it stayed at 90. So, and what the analysts are saying right now is after all these downside scenarios, the oil price still at 90. And that's probably because the people don't misunderstand that the situation on the mid to long term is really tough. Because, as I said, I mean, you see here on the right side different scenarios from International Energy Agency, from the BPs, from the OPEC, and you see that on the general case, until 2030, the oil demand is not really coming down. Maybe after that, if you look on some green scenarios, sustainable scenarios, yes, we will have a decline in oil demand. We need it, I mean, from different perspectives, but not from today to tomorrow. And the reason is that what a lot of people misunderstand is that oil is not just cars. I mean, yes, 55% is transportation, and from there is 1/4 or half of that half is passenger vehicles. And here we see a substitution into electric vehicles and other forms of transportation. Yes, but we don't see any really important move over the next few years in aviation, in shipping. And that's only half of the demand. The other half of the demand are the petrochemicals, the power, the buildings, and there the substitutions opportunities are nearly zero. And that's the problem, and that's the reason why we see oil demand grow over the next few years before it starts really to come down, because we see substitution technology, substitution probabilities going in these sectors, and that needs a lot of time. On the other side, on the supply side, as I said, I mean, after 10 years without investing, you have a problem that oil is consumed. So you have to refill it. You have to find new sources. And if you don't invest, I mean, if you don't do the equipment, if you don't do the rigs, you're not able to bring on enough supply at the right time. And over the last 10 years, the whole industry had so much problems. So many companies went bankrupt, and they declined. They had to reduce the size of the employees, the size of the project. So the capex came really down, and we're in a level where if we don't invest, if the companies don't invest, you see it on the left side. You see that the supply is coming down because of a natural decline. If we go back to an average capex level, we may go for some supply addition. But to have enough supply, they should triple their capex investments. They don't do it. They don't do it because in the public listing companies, after 10 bad years, now being the most cheap sector in the whole industry, in the whole equity world, They want to attract the investors back with shares, buyback with dividends. They are not investing. I mean, the industry always spends so much that now the mindset is, no, let's save, let's generate free cash flow and distribute it to the shareholders. And with the prices today, they're earning a lot of money, as I will show you. So we have in the midterm a really big problem with the supply. And if you consider that even Saudi Arabia is not able to increase a lot the production, I mean, they just said we are now producing 12 million barrels per day, we may go to 13. But what happened in Nigeria? They used to produce 4, they are now at 1.2. What happened to Venezuela? What happened to Ecuador? All this government is a good picture, because if you have a government-owned oil company and they earn a lot of money, but they don't do any capex, the supply goes down. Mexico, Pemex. So that's the example of what happens if you don't invest in your infrastructure, in new projects, and the supply comes down. And that puts us in a problem in the midterm, we think. And we call it even a new energy order, because what we think, if you look to this chart, is, as I said, 80% of our primary energy consumption is based on fossils. That's the reality. 20% is clean or renewable, considering where you put nuclear. But we hope, and there are big efforts, that we move this down, of course, and we increase the renewable part. But it's a process, you know. And what people misunderstand is that's the primary energy consumption. The secondary energy consumption, 60% of it is electricity. And here, as you all know, everything is electricity right now. iPhones, cars, take what you want. So here is where we see a huge increase in renewables, you know, and that's important to put into text afterwards for metals, because all these renewables are hugely intensive in metals. As you know, the Tesla has a weight of 2 tons, you know. There's so much copper, so much aluminum, so much lithium. So here is where the energy consumption, the electricity consumption is going to increase at least 40%, as we all know. And that's a huge trend. But today, we are 80% fossils. And if you go to the companies, and that's something really important, because the companies, they used to see on the right side, they used to spend everything they earned. You know, the capex was nearly as high as their cash flow from operations, or even higher. So their free cash flow was really low over the last few years. And right now, after this crisis, they said, no, we want to spend any more. We want to show it to our investors. We give it them back. So the free cash flow they're generating today is as high as never before. I mean, the industry is doing 550 billion free cash flow this year, twice last year. That's 5 times more than Apple. And Apple has a higher market cap than all the listed companies in the oil and gas universe, you know? And we have a P of 6. Historically, it was 15, 20. So here on the left side, you see the cash margin of the producers, because it's easy business. If you look what their cash costs, you know, they produce for $15 1 barrel of oil. They sell it in an average for $70. So their margin is as high, over 75%. So they are earning a lot of money. And what happens now? They're reducing their debt. They are cleaning their balance sheet. They are generating a huge free cash flow. You see it on both charts. And that's one of the reasons that, for example, Warren Buffett, I mean, maybe you have known, Warren Buffett, his third biggest position is Chevron. He's starting to buy Occidental like crazy, you know? So a lot, if you want to have a deep value with really good returns, hugely attractive valued, because what happened over the last 10 years, there were a lot of ESG reasons and other reasons why you wouldn't have oil and gas companies. I agree. But today, they make up 4% of the S&P weights, you know? I mean, 2 years ago, it was 2%. So put it in context. Is oil only 2% important of the S&P, or for the GDP from the world? Or 4% today? No. I mean, what the influence of oil? I mean, I always said, comparing to Apple, if Apple tomorrow goes bankrupt, we will be sad, but we will survive. If all the oil and gas companies would tomorrow go bankrupt, we will have a problem, I guess. And Apple is bigger than all the oil and gas companies together, you know? So is there a valuation? Is there a comeback? Probably, we think, because if you compare it to the S&P, what did the oil and gas companies over the last few years? Yeah, they had a good run over the last 2 years, relative, but historically, if you look at over 10 years and take the price book, take the price cash flow, you see it. We are nowhere compared to the whole industry. And that's one of the reasons we think the industry is so attractive. And we are one of the few investment managers in this space. I mean, that's reality. When we started our Energy Champions Fund, like 8 years ago, there were like 80 energy funds. Now there are 20, you know? So we're one of the few that survived, you know? And we had some tough times at the beginning because we started in 2014 when the oil price was at 90. 3 months later, it came down to 40, you know? And after that, we recovered a lot, and mainly over the last 2 years, it did nearly 200%. We were last year the best energy fund on considering our peers on Bloomberg. We did a really good job, and I think here, if you look year to date, over 30%, the only sector in green in the whole, all the equity markets, or probably in every kind of asset allocation class. So I think the energy space offers a huge opportunity. And if you looked from the fundamentals and now look to the company specific figures, I mean, we look really detailed to our companies. We know exactly where they produce, what costs. I mean, our producers have cash costs of $14. They have a reserves valuation of $10, you know? And if you look to the figures, I mean, you see on the left side, price cash flow of 4, EV/EBITDA of 3, with a EBITDA margin of 60%, a free cash flow yield of 20%. And now comes the other part of the story that I said, they're generating so much free cash flow, they could go private. And we had the first shale co-producer, like Continental Resources, saying, you know what, I go private. And they could do that in 3-4 years. You know, that would not be good for ESG reasons. But anyway, so dividend yields of 5%. And you see our stocks, you probably know some of them, BP, ConocoPhillips, but we have also ICG in the North Sea, or Diamondback Energy, US shale producer, a lot of in Canada. Well, you see our production mix from a geographical perspective. We know where they are, even which bassin. You know, we know how much is in the Eagle Ford, in the Bacon, you know, and we know exactly where it is. We have a lot of Norway right now because UK or the North Sea is generating a lot of margins, but also in the US or North America. And that's the part of the Energy Champions Fund. What I wanted to go through, it's also the Industrial Metals Champions Fund, because what we heard from our investors saying, okay, maybe you need energy right now if the energy transition takes a bit longer as expected. But in the medium to long term, there will be an exchange, a substitution, hopefully. And then you need metals. And why metals? And why industrial metals is because of the decarbonization. I mean, the new energy world order is based on that we increase our renewable technology supply, you know, and for that to get really a smoother and a transition, and to get more renewables into the market, and to have really an impact on the environmental side, you need to increase a lot the supply of renewables. I mean, here the sustainable development scenario of the international energy chain shows you that you should reduce coal, gas, oil, and really triple or 4 times more wind, solar, and hydro. But to really get the sustainable scenario, our efforts have to increase even more. We need to put every year 3 times more solar panels, 3 times more wind turbines. We need to improve our network, electricity network, and we need to have a lot more electric vehicles, you know? So that's the yearly supply we need really to decrease the carbonization of our environment, you know? And for this, we will need a lot of metals, because that's one of my favorite charts, is to showing you that all the new renewable technology forms, they need like 8 to 15 times more metals. I mean, put in perspective, an offshore wind turbine with 30 megawatts is as big as the Eiffel Tower. You have the North Sea full of Eiffel Towers as wind turbines that need 125 tons of copper, 21 tons of aluminium, 1,700 tons of steel. Take it what you want, you know. So much supply. And where should they come from, you know? The same with electric cars, as you see it. I mean, I call it, the Tesla is 3 tons compared to a VW Golf with 900 kilos. So we need 3 times more metals. resources to get this technology advanced. So we will need a lot of industrial metals. It's estimated we will need yearly 4 times more than we do today. And the problem is that this is also the demand. Now comes the supply. After 10 bad years in commodity markets, nobody invested. Nobody spent $1 in exploration or finding new projects. And that's one of the side. The other side is that we have in the metals a huge concentration. I mean, you see it on the left side. Copper comes from 3 regions to over 50%. The same with nickel. That's 65%. Russia, Indonesia, Philippines. If you take cobalt, one country mines 70% of the supply. And you see the other metals, So here you have a huge concentration. It's not that you can go here and find something here around the corner. No, you have to go to some difficult jurisdictions and you have to get access. And then comes the other problem. That one side is the primary supply, the secondary, the refined smelting process of some of these metals. What happened over the last 30 years? It went everything to China. So copper refining, lithium refining, nickel, cobalt, rare earth, it's concentrated in China. So you have to have this access, And now you heard the Volkswagen and the Tesla saying we need more supply access because they are realizing how tough it's getting. And we have low inventories in metals. We have nearly no new projects. I mean, to put it in context, we consumed 700 million tons of copper in our history of the world. If we want to have the energy transition done, we need to do that again, as much supply, but in 22 years. So just to put in context how much supply we will need if we want to get electric cars, wind turbines, solar panels, and so on. So, and the miners, they're also, after 10 bad years, they improved their balance sheet, they increased their margins, and they're doing really good. I mean, yes, the miners had some cost inflation problems this year, like everyone in the industry, but even so, their margins are twice their history. I mean, you see it here, the free cash flow is also huge, and their debt is going down. I mean, the precious metals industry is debt-free this year, and their free cash flows are also increasing. So I think both sectors are hugely attractive. And also here, we have an industrial metals focused fund for over 5 years. We have the longest track record. We're the first one focusing on this specific sector. We had over 2-3 years fantastic returns. We are beating 90% of our peers. This year was a bit more difficult because of China. China COVID zero is a big metals consumer, but even so, taking this scenario, we are really optimistic for our industry. And if you look here, we also know exactly where are our producers, what costs they have, what multiples you see, price cash flow 4, EV/EBITDA 4, P of 7, nearly debt-free, 60% net debt to equity. They produce it's all in the industrial metal space, we convert everything on copper equivalent basis. So they produce for $4,000 and they sell it for $8,000. So you have also a huge attractive margin, free cash flow. And some of the producers, you know them, BHP, Alcoa, Albemarle, and Atalaya. There are some smaller companies, but also a lot of the big ones. And here's important because what I usually say, we heard that from a lot of investors. They say, okay, if you speak about energy and you say in energy I have Shell, okay, you have Shell or BP and you have like one company doing everything, gas, oil, refinery, pipeline, LNG, over 50 countries. But in the metal space, that's not possible. The bigger one, the two biggest one, BHP, Rio Tinto, are hugely concentrated. They are 60% iron ore and 80% Australia. So even if you take the two biggest, you don't get like a diversification from a commodity perspective or a geographical perspective. So you need, even taking the 5 biggest mining companies, you don't get a really diversification. So we, with our 25, we have a better commodity mix and geographical mix. And I think that's what makes sense, because you want to have, if you need, look which metals are needed for which technology, you need a lot of aluminum, copper, cobalt, nickel. You need a lot of different metals. And you just get that if you invest in different companies. And therefore is our product, I think, a good add-on on this right situation. And maybe just two slides about our investment process. It's really, how shall I say it? That's like a sum up. We have our process really standardized. We have a value focus because we looked into cash flows. We are economists. So what we want is a company that has high margins, low costs, healthy balance sheet. And for that, we developed a scorecard or quantitative model or factor model, call it as you want. But it's like a model that helps us to quantify which one are the relative best in class. And we invest always in 25 companies over all our funds. And we have ESG integrated. It's really important nowadays. So we really track which one has lower emissions, which one has lower water consumption, and so on. And we're really transparent. You see our positions. We show everything without problems. And that's some of the scorecard. And the scorecard is based on 6 pillars. And that's probably as you see it. So it's not just the best returns or the biggest dividend or the biggest or the healthy balance sheet. It's a mix of all these variables that take us which are the relative best companies that we want to be and participate. And because we have integrated ESG, we also have quite good ESG ratings from MECA and the other ones. So because we also all quarter we show a ESG report, we show, look, our companies having half the emissions as the others, and so on. And just to put the last point is that I think commodities, they have a bad reputation for ESG. And I agree that in the history of the industry, not everything was well, but meanwhile, they improved so much. And here you have the real impact, because if you have a steel producer from China or ArcelorMittal in Europe, I mean, they have 1/4 of the emissions, you know. So if you invest in the good ones, in the ones that are really improving their emissions, and here you really have an impact, because we are speaking, some of them are polluting, but they do it relatively better. So you really have an impact on the world. So I think, as Larry Fink from BlackRock said, you should meanwhile be invested in those companies to speak with the management as we did and say, hey, come on, look to your ESG footprint and improve it. And then you really generate something for the world. Well, that's all, I think. An overview about our funds. We have also a precious metals fund where we try to get more silver and PGM, because also on the energy transition story, I think these metals are more interesting, but it's 60% or 70% gold still. But we have a bit more focus on the other metals in the precious metals world. And it's what we have, from fossils to industrial metals to precious metals. It's our pipeline. So happy to get questions. Yeah.
Okay, thank you very much, Pablo. I think now is the time to open it up for questions. So I think Annalisa will be able to unmute the participants. And if you have a question, just go ahead and ask. I might, for the time while people are still thinking about what they want to ask you, just the first question. Why 25 companies? How did you sort of decide on that? And how is your process in sort of finding the stocks, and how are you diversifying over these 25 companies?
Yes, thank you, Stefan. Yeah, I mean, I was a bit too fast speaking about our investment process, but the process is that we look to different pillars of a company, and at the end, through this scorecard, we have like which one are the relative best. And we have a concentration. I would say 25 companies is quite concentrated for an active fund manager, because we are persuaded of the companies. I mean, Equinor, you know, it probably has Statoil. It didn't become a great company from one year to the other. So it's a company we have for 8 years in our fund, you know. So we looked at the track record of a company. So a Rio Tinto or a Tech Resources, there are some companies that did a really good job over the years. So we track all their different operational metrics, because we have we have 2 persons doing the whole year only getting operational data from the annual reports, 10Ks from every company. We have a huge database for over 500,000 figures, where we look what are the production costs, every oil company. What are the production costs per gold ounce, per copper? Where are their reserves? So we track every operational figure, we put it in our database, and with these figures, we can elaborate which were the relative best ones on these different metrics, you know. So we looked at the margins, cash margins, reserves valuation, we looked at the dividend yields, to the emissions, to the multiples, price book, price cash flow, return on equity, return on capital adjusted. So we have a lot of metrics where we rank it, and the sum of the best one gives us the scorecard where we say the 25 are the best, and on those we want to be invested. And why 25? It's probably a usage limitation, because you are not allowed to have any position bigger than 10, and well, there is also special rules. I don't know it by memory right now, but I remember when we elaborated the allocation, we said, shall we get just 15? And they said, no, it's not possible because of usage. So we came up with 25, and we kept it for all our funds, and we're happy because we usually do equally balanced. So every position is 4. And with this, you make some contribution. If a company is good, it shows up on the performance. On the other side also. But as I said, I mean, we are persuaded investors. We have a value focus. We have no exploration company. That's important because we need cash flows. So it's another mindset. I mean, you see a lot of fund managers having a lot of exploration companies. They may find some gold in Indonesia. They may have the best super asset in Congo or Mongolia. I'm not a geologist. I want to have the track record. I want to see their production, their costs, their reserves. I want to have a track record, and that's different mindset. But I think it's the right mindset right now, because you need commodity exposure today and not in 10 years.
Okay, yeah, thanks. Just as a pointer, there is a panel that I think everybody of the participants should see, and it has the little microphone sign. So if you have a question, just unmute yourself and ask your question. Again, maybe just to bridge the time.
Sorry, this is Caterina.
Hola.
Can
Caterina.
you hear me?
Yes,
Ciao,
I can hear.
How about if there is a recession, let's say, maybe, how can the recession impact on the valuation of your
good question. I mean, recession fears are everywhere, you know, and what I usually say, I mean, if there is a recession, the demand is coming down, no doubt about it. But I mean, in oil, for example, we had just 10 times an oil demand decline over the last 60 years, you know, so there will be an impact, I mean, nowadays, and we have some supply chain issues, and considering oil or energy, it's a bit more difficult to see a really came down on demand as heavy probably as in other, because metals, yes, metals is more infrastructure, real estate, and China. I mean, for a lot of industrial metals, 50% of demand comes from China, and if China has a problem, it will be felt on the demand side and on the valuation of the companies. But take it on the other perspective, as I show it here. I mean, you have a price cash flow of 4. I mean, they produce for $15. If they sell it for 70 or 60 or even 50, they have an EBITDA margin of 50%. What happened to those companies is the same that will happen probably to the coal industry. I know coal, nobody has coal. It's hated. What happened to the industry? They had to survive. They even get finance. So even the banks don't participate with gold. So they had to improve their balance sheet. They had to get net cash, and they went out of market, you know? So the same will happen probably to the oil and gas industry, because they would say, look, nobody likes us. We have a valuation of 4. So in 4 years, I could go private, you know? And then I still generate these margins for 10 years, 20, take it what you want, you know? So what I would say, I don't know how much lower it can go. I mean, we have already price cash flow 4, or I mean, 2. I mean, even the Russians didn't have 2 10 years ago, you know? So I don't know how much on the valuation perspective. It will go down, definitely, and there will be an impact, definitely. But from a valuation perspective, if you ask me, I mean, it's as cheap as never before. I've never seen such figures, you know? And that's probably also driven because of the recession fears we had lately, you know, and the margins, they're healthy. So I don't know how much it's going to go down. It will, but I don't think that we had already our correction. I mean, it's what I usually say. I mean, while the other markets had 10 fantastic years, you see it here. Well, that's the multiples, but it's the same. Well, here you see the relative performance of the S&P versus the net resources, you know. So we had already our correction. And this industry, I mean, you see it from the oil majors, they are really good, not really good, but they used to have crisis. They had to adjust their models, business models so many times, you know. So I think the commodity industry is doing quite well also during crises, relative. I think that helps you to understand my point of view.
Yes, thank you. And okay, thank you.
What about, let's say, government intervention? Obviously there is a clear goal to go net zero. Most governments have probably unrealistic plans, but they basically want to achieve it. And so how big is the risk of continued increased pressure, more regulation? How do you see that going over the next 10 years? That the political process will simply try to force by all means a change, even though that the economics are not really there for the change.
I mean, that's a really good point, Stefan. I mean, I like to say it like this. I don't remember, but my boss is happy to remember me that on the oil crisis in the 70s was the first milestone for renewables. Because what happens in commodities a lot of times is that when you have high prices, the people start to look for substitutions or new alternatives, you know. So the first milestone of renewables was in the 70s when the oil price, I think it went by 12 times up, you know, oil embargo. So the same is not probably happening today, but you see right now big efforts from every government to push renewables. We have like the Repower EU with 200 billions. We have the Climate Bill Inflation Reduction Act with 300 billion. So now the people start really to push for renewables because we have high prices. So the commodity traders, they like to say, what's the solution for high commodity prices? Even higher prices, because only this is really driven innovation. You know, I'm persuaded that some genius people will find solutions for these problems, but you need a higher incentive probably through government subventions, government subsidies, and so on. You know, and the problem of this industry, and that's the poor part of the story, is that the renewables may make sense, but they are nearly not profitable. From the technology perspective, you may see the Ørsted, the Gurit, the Vestas. With the commodity price inflation, their margins are really low. They have fully books, but the government process to get a wind turbine online is so bureaucratic. And the same with other industries. And if you take off the subventions and subsidies and so on, it's really a tough market, but it's moving in the right direction through this crisis. And I think it's good to see a movement, and it needs a lot more. But we have to be realistic. The politicals, they would love to see tomorrow already happened, but it's not from today to tomorrow. It's a transition. It takes time. And if you start to pain as some politicals want, take money away from the energy producers, you know, I mean, they have less CapEx, free cash flow from operations, less investments. So bigger comes the problem. So it's a trade-off. I don't have the solution. But what I can say, and I think that's important, is that I'm persuaded that the efforts, the innovation, technology innovation, because for me, it doesn't make sense to drive a 3-ton Tesla. I hope the battery gets better. I hope the size comes down. I hope they improve. And for this, you need a lot of innovation and technology, and this is done right now, and that's important.
Again, if there are questions from the clients, unmute yourself, press on the little symbol for the thing, and then you can ask your question.
Sorry, Pablo, I have a silly question. May I go on?
Yes, of course.
Again, it's not related to the fund, but you are really into this. How long do you think that how long this transition will take? Like, is it possible net zero by 2050, or this is like, I don't know.
Tough question.
I know, but you see more papers than I do,
Yes.
or we do, and you read much more. So all these scenarios.
What's sure, that's really complex to evaluate, because there are so many things going into this cake, you know. And it's what we see. I mean, you see the paths the International Energy Agency is saying to you. They say if you want to have a sustainable development scenario, and that means to really decrease the carbonization, so you need to produce every year from today to 2040 3 times more solar panels. Do you have the access to the commodity? Do you have as much supply? Do you have as much opportunity? I mean, wind or solar, I mean, as you probably know, who are the main suppliers of solar panels and wind turbines? The Chinese. You know, in Europe, you see the problems we have in Europe to get an agreement or a wind turbine done. So even they say, if you want to have sustainable scenario, we need 3 times more wind turbines. I've been last week in Spain, and we have in the north part, we have a lot of wind turbines. But if you see the tracking, the logistical problems to get one wind turbine from the background, from the port to the hill, and so on, I mean, it's not an easy job, you know, it's really a lot of work. And we see now in the EV, electric cars, we see maybe in Switzerland, we have a higher standard of living, we see a lot of electric vehicles, but do you see today in 20 years a second-hand Tesla in Pakistan, in Uganda, in Mexico, you know? So the whole process, it's driving on the right direction, but is it fast enough? I doubt a little bit, you know? And I hope we will improve, and I'm sure we will improve. And also electricity networks. I prefer to say we're in Switzerland. If you live in a real estate with a lot of apartments and living, so you have a garage box, there used to be 2 Teslas, now there are 5. The electricity network it doesn't work anymore, you know? So you have to improve everything, you know? And that's so much investments, so much efforts that's being done right now. And I think they have to increase even more. So the whole transition story is a big story, and it starts at us, because the biggest effort to get really sustainable, and that's the point where the most people, well, right now not, but if you look here on the left side, you see the red line and you see the black line, stated policy scenario. If we keep it how it is right now, our primary energy consumption is going to increase. So the biggest help for the environment is to improve our efficiency. And we see it right now in Europe. What's the biggest driver of energy efficiency if we have to pay a lot? So right now you see everywhere electricity companies saying to the consumers, to the households, save electricity, save heating. So if really want to get a sustainable development scenario, the biggest effort we can do is improve our energy efficiency. And that would be the most helpful part. And that's a really important one. So that's where I most hope have, honestly.
Pablo, sorry, this is you, if I may.
Sorry, Ciro. So that saying that you said that means that for the next 20 years we really need fossil. I mean, we can't escape from fossil energy. That's it, right?
Well,
for the next 20 years, it's very important.
Most probably, yes. I mean, it's difficult to say what is the technology advantages, but for the next, until 2030, take any agency, any analyst, they will say, I mean, you may reduce oil demand by 5 million barrels, 10 millions, but we are consuming 100 million barrels per day. As Stefan was putting, every 14 seconds, one swimming pool, you know, Olympic size. So do you change that from today to tomorrow? No, it will change. We will have efforts. We will have improvements. I mean, also the gasoline car, I mean, be honest, they won't consume 10 liters per 100 kilometers tomorrow. They will consume just 3, you know. So we have an improvement everywhere, and we will have less fossils, hopefully, over the next few years. It's going to zero.
But still we need a lot. That's the
Definitely.
point. So
Definitely.
invest in oil and gas.
I mean, it's not the most famous and not the most loved sector, but that's an opportunity because we had 1,500 institutions saying not investing in fossils. And right now, they are missing on performance side because, as you know, they like to be passive, they like to be ESG passive, and they're underperforming because the only sector that's on the green part.
Yes, and one argument can be also you need to invest in these old, like say old or whatever companies because they help to the transition. The transition needs this kind of. Okay, I mean, thank you, Pablo. Sorry.
No, I have to add something. That's really important. If you look to the Shell, Total, BP, take which one you want, Equinor. Equinor is one of the biggest wind offshore turbines producer in the world. And honestly, they have the best engineers. If they put a rig in the North Sea or a wind turbine, I won't say it's the same, but they have the qualification and they have the capital. That's the most important thing, because there were companies saying, oh, Shell, you have to pay more because you're damaging the world. And he said, look, the money we earn, it's huge. Okay, we had 10 bad years, but we are investing in the energy transition. They are investing in renewables, in solar, in wind, and they may even change. So I'm persuaded that the Shell, BP, Total, today in 10 years, there will be no oil producers. There will be energy producers. They will do the whole supply chain because they have everything: gas, gas transition, gas pipeline, LNG port. They just need power. So the next step for them is to produce power. They will become a utility, I'm sure. So they will move from oil into energy. So, and they are really helpful because they have all this knowledge, capital, and that's also part of the solution.
Yes, thank you.
Pablo, what I wanted to ask before, and it's more, I don't know if it's really linked to this, but it's my understanding that the Western world is quite linked to China, and because they have most of this, how do you say, products which we need to, this commodity which we need to build up the solar panels with. Is there a plan B? Because I'm a bit afraid about the situation which is currently going on with China. Do you know if there is a plan B or a part of maybe nuclear, which we still have to buy from Russia then? Because I think, is there a plan B for us?
Plan B. That's a good question, Ciro. That's the reality. I mean, we have a huge concentration of some assets and know-how in such countries. And that's, I mean, that's a development we had in China. I mean, they became pioneers. I mean, they used to copy paste, and now they are the 10 of the 15 biggest wind turbines producers are in China. I think 80% of the solar panels are produced in China. You know, they have the refining of these commodities. They improved a lot, you know, and if you look at our circumstances in Europe, with higher wages, higher complicated supply chains, we may have some market in front of our whole store, but the economies of scale, I mean, that the Chinese are pioneer, you know, so their economies of scale are bigger, because on the other side, because they have, I mean, the biggest solar panel producers and consumers are the Chinese. They are building, I don't know the number by memory, but they are producing so much. And it's the same with solar, same with nuclear, same with a lot of new renewables forms are being produced already in China because they have a huge demand inside. So that's maybe the reason they are getting economies of scale and innovation. While we in Europe, we have the Siemens Energy, we have the Ørsted, and they are doing well, but they have a huge competition coming from abroad. That's make it difficult, and also from the supply side. I mean, if you look to the margins of the Vestas and Gurit and Ørsted, they are 3-4% EBIT margin. I mean, that's like in the car industry, what happened to the car producers, their margin is so thin, you know, and that's not sustainable for an investment case and business case. And you would take the subsidies away? I don't know. I mean, I hope it improves and they get better, but it's a tough situation. Do we have a certain solution? Energy efficiency, it's the only thing. We can start to save everyone more. That's the only thing, and that's probably the easiest way. But we need innovation. I hope there will be a lot of innovation to help to find new solutions. But right now, I don't know. I mean, nuclear, it's a bit discussion about it's probably not renewable, but it's clean, definitely clean and economical, but there are other risks. And yeah, but as you see it, I mean, there's so much discussion. So even if nuclear, I mean, if I may say some things about nuclear, the nuclear power plants of today, they are modular. I mean, that's what Bill Gates posted. I mean, you don't have to build a big nuclear plant. You know, you can do smaller ones. There is a copper company in Poland to improve their ESG transparency and figures. They are building a small nuclear plant at the mine somewhere, nowhere, you know. So I think there are some opportunities because also there the technology is improving, you know. To just say no, we don't like it because it can be dangerous in an old kind of style, okay, but the improvements there, they're also big. So I think you should be a bit more open to every kind of technology. Also hydrogen, I mean, there will be so much potential if you will really invest more there, you know. So I think the innovation and the improvements have to come up much more. I hope that's my only solution, Ciro. Maybe you know another one.
Nuclear fusion.
Yeah.
Okay. 11 is approaching. Any last questions for Pablo? If that's not the case, then I think we would wrap it up here. I want to thank Pablo and ICG for the webinar. It was very interesting. Thank you. And I would like to also thank all the clients for attending and for your interest. As mentioned quickly before, we will have recorded the webinar and we will send you the link, including the slides that Pablo used for today's presentation. Thanks a lot again for your interest, and everybody have a nice day.
Thank you so much. Also from my part, big pleasure. Thank you, Open Funds. Thank you, Stefan. Thank you to the whole team behind organizing it. It's a big pleasure. If you have any questions afterwards, just give me a call. We are here. We are always ready. We are speaking the whole day about energy crisis. So just go on, no problem. Thank you so much and goodbye.
Thank you. Bye-bye.